Have you ever stopped to think about how interest rates might be silently stealing your money without you even noticing? If you think they only affect people with debt, you're very mistaken. Interest rates influence everything, from the returns on your investments to the prices of products at the supermarket. In today's video, I'm going to show you how they directly impact your wallet and, more importantly, what you can do to turn the tables in your favor. Stick around until the end because I'll reveal strategies that can help you maximize your gains, even when interest rates are high. Interest rates are one of the most powerful forces in the economy, yet we rarely give them the attention they deserve. Have you ever noticed how a simple change in rates can shake up your financial life? They don't just affect your mortgage or credit card payments, they can also have a direct impact on the investments you make to secure a better future. While interest rates are rising, you could be missing out on opportunities or even losing money without realizing it. But don't worry. In today's video, we'll break down this mystery, and I'll show you how to adjust your strategy so that instead of being harmed, you're always one step ahead. Now that you know interest rates are more present in your life than they seem, the goal of this video is to put you back in control. I'll teach you how to make these rates work in your favor without needing to be a financial expert. In the next section, we'll understand how interest rates impact your investments and how to adjust your portfolio wisely. Before we continue, if you want to learn how to master interest rates and transform your investments, subscribe to the channel and turn on the notification bell so you don't miss any tips. Now, let's move on and see how these rates can directly affect your earnings. Now that you know interest rates influence much more than just loans and financing, it's essential to understand exactly how this mechanism works. And believe me, it's simpler than it seems. Imagine the economy as a faucet that controls the flow of money. When the Federal Reserve, known as the Fed, decides to raise interest rates, it's like tightening that faucet, making access to money more difficult and more expensive. This means banks will charge more for loans, mortgages, and even credit card limits. On the other hand, when the Fed lowers interest rates, it's like opening that faucet, allowing money to flow more easily. This encourages consumption, investment, and often stimulates the economy. Now, here's the crucial point. The same interest rates that affect borrowers also have a huge impact on investors. When rates rise, conservative investments like government bonds and savings accounts start offering more attractive returns. But when rates fall, those same investments generate very little, forcing investors to seek riskier alternatives to boost their returns. This dynamic directly affects your investment portfolio, and if you don't understand how to position yourself, you could end up losing money even without doing anything wrong. And that's exactly what we're going to talk about now, how these rates influence different types of investments, and more importantly, how you can protect yourself. Let's start by talking about investments that many people consider safe, fixed income securities. In the United States, a classic example is Treasury bonds, which are government-issued securities widely known for their safety. Now, here's what many people don't know. When the Fed raises interest rates, new bonds are launched with higher yields to attract investors. And that causes older bonds, which offer lower returns, to lose value. It's like trying to sell a used car in a market where new cars are cheaper and offer better features. Imagine you bought a government bond that pays 2% per year. If, after some time, the Fed decides to raise rates and new bonds start offering 4% or 5%, who would want to buy your bond with lower returns? Exactly, almost no one. This causes the value of your bond to drop if you try to sell it before maturity. That's why, if you have money invested in fixed income, it's essential to stay alert to interest rate changes. Otherwise, you could end up losing part of your investment's value, even if those securities are considered safe. Now, if you're thinking, okay, but what about stocks? Are they affected too? The answer is yes, and that's what we're going to cover next. When interest rates rise, the stock market often reacts, and not always in a positive way. This happens because many companies rely on financing to expand their businesses, open new branches, develop products, or even pay their bills. With higher interest rates, these companies pay more to borrow money, which reduces their profits and can slow their growth. And you know what happens when profits fall? Those companies' stock prices tend to lose value. Now, here's an important tip. Not all companies are affected in the same way. Businesses that deal with essential needs, such as energy companies, food providers, and healthcare services, tend to be less impacted because their products and services remain essential even when the economy slows down. Additionally, banks and financial institutions often benefit when rates rise since they can charge more for the loans they provide. Knowing how to identify these details can make all the difference in how you build your investment portfolio. Speaking of which, I'll now show you how to protect your wealth and even profit when interest rates are high. Now that you understand how interest rates affect different investments, here are 3 practical strategies to protect your wealth and boost your gains. Diversify your portfolio. Don't put all your money into stocks or just fixed income securities. Mixing different asset types helps balance risks. When one market is down, another may be up, and this creates natural protection for your money. Consider sectors that benefit from high interest rates: banks, insurance companies, and businesses that manage large cash reserves often perform well when rates increase. Having these assets in your portfolio can help offset losses in other investments. Evaluate your older investments. If you hold bonds or assets purchased when rates were low, it may be time to reassess whether it's worth keeping them or switching to more profitable alternatives. Adopting these measures can put you in a safer position and even help you profit while many unprepared investors lose money. If you're finding these tips useful and want more content like this, don't forget to leave a like. This helps spread this information to more people who also want to understand how interest rates affect their finances. Now that you know how interest rates can impact your investments and how to protect yourself to ensure your money continues to grow, regardless of the economic scenario, remember, financial learning is ongoing, and there are many more strategies you can apply in your daily life. If you want to dive even deeper and learn how to build an investment portfolio that truly shields you from economic ups and downs, I've prepared more amazing content for you. Click on the videos appearing on the screen now to continue your journey and achieve the financial freedom you deserve. See you there.